السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.
I know many of you have seen a lot of videos on chart patterns on YouTube and how to trade them. But most of these videos don't tell you why you should trade them and in fact why these chart patterns actually work in the market. So this is going to be one of the most comprehensive courses on chart patterns out there. Many professional traders even sell paid courses on chart patterns that are worth thousands of rupees with very little content. But guess what? This course is completely free of cost and is exclusively for educational purposes only. So share it with all your fellow traders and friends. And if you are new to the channel, consider subscribing to the channel and also enable the bell icon so that you won't miss out on any upcoming videos.
Can think of to fix this. Let's start by discussing the trade entry criteria first. Now, the most aggressive entry is when the price breaks below the neckline or the support level. The idea is to wait for a breakout candle to close below the neckline and then take a short entry below the close or the low price of the breakout candle. Now, waiting for the candle to close will ensure that the candle closes below the neckline and suggests that it is not a false breakout. The other advantage of this technique is that you will be able to enter into a trade at a very early stage, but the drawback is that the size of the breakout candle can be too large sometimes, which can badly reduce your reward to risk ratio. In some cases, it is always beneficial to wait for a price build-up to form near the neckline, which acts as a support level in this pattern. Now we will take a short trade when the price breaks below the neckline after the build-up. This will ensure a higher probability of success because the trader who are long near the neckline or the support will have their stop loss orders placed below the support level, and this will cut their losses if the market continues to head lower. And once price breaks below the support level, all these sell stop loss orders will be hit, which will add further selling pressure, thereby increasing the probability of success. On top of that, this trade will ensure a more favorable reward to risk ratio as you will have a much tighter stop loss. Anyway, the problem with this approach is that the breakout candle can be too large and also the fact that only a limited number of trades are available. Now, what if you miss the breakout trade? Is it the end? Not really. You can still enter a trade if the prices form a primary pullback in the form of a flag or a pennant pattern. A primary pullback is nothing but a temporary up move of prices with weak candles, most probably due to profit booking. And a good pullback is always shallow and is associated with weak candles. But what if we get a steep pullback with large bodied candles? What will we do then? Yet again, we can look for a retest of prices back to the neckline, which will now behave like a resistance level where we can expect to find the sellers to come in. So if the price do the retest, then we will wait for a price rejection from the neckline in the form of bearish reversal candlesticks like shooting star, bearish engulfing pattern, evening star, etc. And if you find there is a price rejection, you can back yourself to take a short entry as the price begins to move lower. The retest entry provides a better entry price than any other entry methods, but the downside is that the prices don't always give a retest, and especially in strong trending markets, you don't expect pullbacks or retest. Above all, make sure to confirm the breakouts with higher than average volumes and using other momentum indicators like RSI, MACD, etc. Your stop loss should be at a level that if breached will invalidate your trading setup. Since we are trading a double top pattern, our stop loss should be at a level that invalidates the pattern altogether. In that sense, if the price moves above the swing high of the pattern will be invalidated. But there is a small twist. Number one, if we do this, the stop loss can be too large and so the reward to risk will be very low. Secondly, the market can move up to the top of the resistance level and then reverse lower after hitting your stop loss just to form a triple top pattern and then move lower completing the pattern, which can be really frustrating. So what I recommend is to either place your stop loss at 50% level between the swing top and the neckline, or if this distance is too large, then set your stop loss with an adequate buffer using the ATR indicator just above the breakdown candle high. This could be your stop loss. Your entry was very aggressive, that is, you went short as and when the price broke below the neckline. Now what if you took a short entry after a build up near the neckline? Then you get the freedom to place a much tighter and hassle-free stop loss preferably just above the build-up or consolidation, which will boost your reward to risk ratio. Now let's say you missed both these entries and you shorted the market after the prices formed a primary pullback. Then you set your stop loss above the highest price in the group of the pullback candles or just above the neckline if the pullback is formed very close to the neckline. Now the last method is if you are entering after a retest. In such a scenario, the stop loss can be placed just above the highest wick of the group of retest candles, or you can be more conservative and place the stop loss at 50% of the width of the pattern. Now how to set your targets? As you may have guessed, there are 3 techniques to exit your trades: price projection, trailing stop loss, and a combination of these 2 methods. Let me explain each one of them. The price projection focuses on price exhaustion. The idea is that prices will move an equal distance to the highest width of the pattern after the breakout. Now, the highest width of this pattern is from the neckline to the swing top or the swing high. So all you have to do is to identify the distance from the swing top to the neckline. Then project this distance from the neckline towards the downside. This will give you your desired profit target. The second method of trailing your stop loss is to ride big moves. We will make use of moving averages of different periods to do this. And the selection of moving averages will depend on the time frame that you are trading on. So for capturing short-term trends, you use a 20-period moving average. For a medium-term trend, you use a 50 moving average. And for a long-term trend, you use 100 or 200 moving average. And we will exit the trade only when the price moves below the trailing stop loss. Now the last method uses a combination of both these methods. The idea is to exit half your positions at the price projection level and then ride the rest of the move using a trailing stop loss. By doing this, you will be able to lock into some good profits and not fall prey to the market reversals. Now, there is one more important piece of information that I want to share, which is associated with finding and trading double tops with a high level of accuracy and win rate, which involves the use of multiple time frame analysis. The concept is rather simple. The first step is to identify a downtrending market or a downtrending price action on a higher time frame depending upon your trading style. I have already made a video on time frame selection. You can watch that video to learn more. Now what you need to do is to wait for the price to approach an area of resistance on the higher time frame. Now if you find such a setup, move down to your lower time frame, then look for a double top pattern on the lower time frame. This is a very simple yet effective technique that allows you to time your trade entries at the absolute highs of the double top pattern, which by the way is the best possible price level that you can get and is also a professional way of trading this pattern. So please keep in mind that if you're not comfortable using this, then you'd be better off ignoring it. You don't necessarily have to consider all the options, just choose one or two that work well for you. Now we will focus on what a double bottom pattern is, how does it work, and how to approach it while trading it. A double bottom pattern is a bullish trend reversal pattern and it is the exact opposite of a double top. This pattern also has 3 parts. It has a first low or first price rejection, followed by a second low or second price rejection, and also a neckline, which is an area of resistance connecting the swing high in between. Now what do this part of the pattern indicate? A first low is formed and the market declines lower, forming a swing low and then moving higher. At this point, it is likely a retracement in the downtrend. But then a second swing low gets formed when the market rejects the previous swing low level and retraces higher again. So we can now assume that there is buying pressure, but it is too early to tell if the market could continue higher. We can only confirm the strength of the buying pressure when the price breaks above the neckline. Now when the price breaks above the neckline or resistance level, it signals the interest in buying and the possibility of the market moving higher. So in short, the double bottom pattern signals that the downtrend has possibly bottomed out and the price is about to move higher. Many traders make this mistake of buying the break of the neckline after a double bottom pattern is formed. But this won't always work in your favor, because if the market is in a strong downtrend and it forms small double bottoms every now and then, the chances are the market is likely to continue lower. In addition to this, not all double bottoms are made the same. The time frame that we use for spotting the pattern and the space between the swing lows or the swing bottoms are also important factors worth considering. So a double bottom pattern formed on a higher time frame is more significant than one formed on a smaller time frame. moving on to the entry criteria for trading. So an aggressive entry is when the price breaks above the neckline or resistance. The idea is to either enter a long position on the breakout, which can often cause the false breakout problem, or you can wait for the breakout candle to close above the neckline and then take a long entry above the close or the high price of the breakout candle. The advantage of this technique is that you'll be able to enter into the trade early and might even get the best possible entry price, but the drawback is that the breakout candle could be too large, or even the price could reverse and give a false breakout and hit your stop loss. The second entry technique is a breakout with build-up near the neckline. This happens when we observe a tight consolidation of prices near the resistance level or neckline. So when you see a build-up at the resistance, it tells you there's buying pressure and people are willing to buy at higher prices despite profit taking or short selling from the level. Also, traders who short from the level are likely to have their buy stop loss orders placed above the resistance level. So when the price eventually breaks out of the resistance, all these clusters of buy stop loss orders will be hit and it will provide the boost that the price needs to move higher. And if the market breaks out of the neckline, you can enter your long trade just above the close or above the high of the breakout candle. Now the advantage of using this method is obviously the tight placement of stop loss and an improved reward to risk ratio and also a very good entry price. But the drawback is that the range of the breakout candle can be huge and you will be buying at a much higher price. Now what if the market does not form a build-up or it forms a huge breakout candle and still continues to head higher? So if you missed both the above entries, the third method is to look for a primary pullback in prices to happen. This technique helps you to catch the price move even after a breakout. So if the market breaks out without forming a build-up, then we will wait for a primary pullback to occur, which is a temporary down move of prices with weak candles. And if the market does a pullback, then you can look to go long on the break of the previous swing high or enter right away when the prices start rising. Now the best pullback should have a shallow retracement with small bodied candles. But sometimes we get a steep pullback to the neckline. This is called as a retest. So when the price retests to the neckline or now a support level, we expect buyers to come in. So we need to observe if price retests the neckline, and if it does, then we wait for a price rejection from the neckline in the form of bullish reversal candlesticks like bullish hammer, bullish engulfing pattern, morning star, etc. And if you find there is a price rejection, then you can go long on the next candle. Now the retest technique lets you time your trade entry and even take up positions at far better prices. But the downside is that there is no guarantee that the price will retest to the level, especially in a strong uptrend, and you might miss out on the trade altogether. Yet another important point to keep in mind is that the volume should increase during the breakout, confirming an increase in the buying pressure. So make sure you use the right entry techniques at the right times. Now let us talk about the placement of stop losses with respect to our entry criteria. The double top pattern becomes invalid when the price reverses from the neckline and closes below the swing low of the pattern. And if you were to place your stop loss based on this idea, then the stop loss would be too large and you will incur huge losses, and moreover the price could reverse from the swing low and move higher again, forming a triple bottom pattern. So where exactly should you place your stop loss? Now what I recommend is to either place your stop loss at 50% level between the swing bottom and the neckline, or if this distance is too large, then set your stop loss with adequate buffer using the ATR indicator just below the low of the breakout candle. This could be our stop loss if your entry was very aggressive, that is you went long as and when the price break out of the neckline. Now what if you took a long entry after a build-up near the neckline? Then you have the convenience of placing a much tighter stop loss, preferably below the build-up, which will in turn improve your reward to risk ratio. Now let's say you have missed both these entries and you have entered a position in the market after the prices formed a primary pullback. Then you can set your stop loss below the lowest price in the group of pullback candles, including the wick, or you can place it just above the neckline if the pullback is formed very close to the neckline. And the last method is if you have entered after a retest. In this scenario, the stop loss can be placed just below the lowest wick of the group of retest candles, or you can be more conservative and place the stop loss at 50% of the distance between the swing low and the neckline of the pattern in order to save yourself from long wicks. And finally, we will discuss how to exit from our trade for maximum profits. And as always, there are 3 methods that we can make use of: the price projection, trailing stop loss, and a combination of both. The price projection calculates the distance between the swing bottom and the neckline. So in the price projection method, you have to calculate the distance between the swing bottom and the neckline. Then project this distance upward from the breakout point or neckline. The projected price point or level is where you exit the trade. This technique will help you decide whether it is too late to enter a trade or not. For instance, if the price is close to reaching its price projection, then there's probably not much meat left in the move and you might want to skip the trade. But unlike the price projection technique, a trailing stop loss method does not have a fixed target. Instead, we trail our stop loss as the price moves in favor so that we can ride the entire trend. So the first step is to decide on the type of trend you want to capture, whether it's a short-term, medium-term or long-term trend. Then you can trail the stop loss with the appropriate moving averages like 20 period, 50 period or 200 period moving averages respectively. And we will exit our trade only when the price crosses below these moving averages. The final method combines both these methods. You exit half your positions at the price projection level and ride the rest using the trailing stop loss so that you will be able to lock in some profits and not lose money if the market reverses. Now same with the double top. You can use multiple time frames to filter for high probability double bottom setups. All you have to do is to identify a higher time frame support area, then move down to your preferred lower time frame and look for a double bottom pattern that leans against the higher time frame support level. By doing this, you can take a trade from the absolute low of the swing bottom, but do keep in mind that this is a more professional entry technique, so don't use it if you can't completely digest it. If you have understood the double top and double bottom patterns properly, then triple tops and triple bottoms are just a piece of cake. These are just extensions of the previous 2 patterns. The entry, exit and stop losses are the same. But what matters most is the formation of the third swing high or swing low respectively. Let's find out what these patterns signify. A triple top is a bearish reversal chart pattern that signals that the sellers are in control. The pattern starts with buyers in control as the price makes a swing high followed by a pullback. But the first sign of selling pressure appears as the price fails to break out of the prior high and the market makes a pullback again and forms a consolidation. This looks like a double top, but this time instead of breaking below the neckline, the market attempts to break out higher once again and fails again. So there are 3 spikes visible or 3 failed attempts to break out higher. This looks like a triple top and is confirmed only when the price breaks below the low of the consolidation or the neckline support level. I won't be discussing the entry, stop loss and target criteria because you can follow the same rules as with the double top pattern. Keep in mind that no patterns, strategies or techniques work all the time. This includes even the triple top pattern. But the good news is that before the pattern fails, it usually leaves some clues. For instance, if the higher time frame trend is still an uptrend, then the triple top pattern formed on a lower time frame is most likely to fail. Now when talking about a triple bottom pattern, a triple bottom is a bullish reversal chart pattern and is quite the opposite of the triple top pattern, and it signals that the buyers are dominant. Now the pattern begins with sellers pushing the prices down as the price makes a swing low followed by a pullback. But the first sign of buying pressure appears as the price fails to break out of the previous swing low. Now the market made another pullback and looked like a consolidation. This looks like a double bottom pattern. But instead of breaking above the neckline, the market attempts to move lower once again and fails to break the low once again. So there are 3 lows visible or 3 failed attempts to break out lower. Now this looks like a triple bottom pattern and is only confirmed when the price breaks above the high of the consolidation or the neckline resistance level. The entry, stop loss and target criteria are similar to the rules of the double bottom pattern itself. Now moving to the last category of pattern.
السلام عليكم. لا تنسوا الإعجاب والاشتراك في القناة تشجيعا لنا لمزيد من العطاء والتألق.